The S&P 500 has had a phenomenal few years, generating a staggering 78% total return over the last 5 years. Now this begs the question, can this continue, or is the S&P 500 now severely overvalued? Now this video will discuss what it actually means for a stock market to be overvalued, whether the S&P 500 itself is overvalued, and what this might mean for your investments, your investment decisions, and how you can potentially capitalise on an overvalued market. Hi everyone, welcome back to the channel. My name's George and I'm a finance professional working in the UK, and I've been invested in the S&P 500 for a good few years now. After learning about investing in my late teens, I started early and put what I could afford at the time into the S&P, and that turned out to be a pretty good decision. As we mentioned, they've had a very good few years. But recently we've been hearing professional investors and commentators saying things like the S&P 500 is now really overvalued. And I came to realise that I didn't actually know what it meant when they said the stock market was overvalued. Like, overvalued compared to what? Compared to other stock markets? Compared to what it was historically? And then I realised if I was going to make proper, well-informed investment decisions, I really needed to understand what they were talking about. So I did some reading, I did some research, and I did some digging around. And now I feel like I've actually got quite a good grasp on what it actually means for a stock market to be overvalued. And as a result, I can make much better informed investment decisions. Now, before we start, I do have to mention that I'm not a financial advisor, and this video is in no way meant to be financial advice. I'm just someone with an interest in the topic of investing and who's done some research and studied a bit of the theory at university as well. But please consider your own financial situation before making any big decisions. So let's get into it. What does it actually mean for a stock market to be overvalued? Well, to explain it in a sentence, it basically means that the price of the stock market is no longer representing the fundamental value of the companies which make up the stock market. Now, to really grasp what this sentence is trying to say, it's really important to understand what the price-earnings ratio is and what it says. And in order to do that, I think it's worth going back to basics. So when you buy a stock or a share, you're buying a piece of a company. Or more specifically, you're buying an entitlement to the profits of that company and the future profits of that company. So the price of the share, or the share price, should in theory reflect a company's profits now and what the company's profits are likely to be going into the future. So the share price will increase if a company generates an ability to make more profits now and into the future. So for example, let's say they invent a new technology, which basically means that they're going to make loads more money now and in years to come. So whoever owns a share of that company will suddenly be entitled to more profits, both now and into the future. So the share price should increase in order to reflect that. Now, the relationship between a share price and the company's earnings can be measured. And this is where the price-earnings ratio comes in. This ratio takes the company's share price and divides it by their earnings per share. Essentially the profits per share that's in issue. So if a company has £5 million in profits and has 1 million shares in issue, then their earnings per share will be £5. So let's say this company has a share price of £50 and an earnings per share of £5, their price-earnings ratio will be 10. So this ratio of 10 basically says that the company's share price of £50 represents 10 times their current year earnings per share. So now let's use the example of them inventing a new technology, meaning that their profits will increase in years to come. So after the news breaks, investors rush in and buy shares in this company, and it pushes the share price from £50 all the way up to £100. Now say for example they haven't actually used this technology yet, they've literally just announced the news, so their profits are still £5 million per year and earnings per share are still £5. This means that the price earnings ratio will now have gone from 10, 50 divided by 5 equals 10, up to 20, £100 share price divided by 5 is 20. So what we've seen the share price double from £50 up to £100, but the earnings haven't changed. Now this is fine so long as it's likely that the company's earnings are going to double in the future, as what this will do is this will bring the price earnings ratio of 20 back down to the historic average of 10. So even though the price earnings ratio of 20 is massively inflated in the short term, it's actually fine because it's likely that it will come back down to 10 in future because the company's earnings are going to double. But now let's say that the company CEO secretly knows that this new technology isn't as good as people think, and in actual fact, it's only going to increase the company's earnings by 5 or 10% at max. So let's think about what we've got here. We've got a company whose share price has increased from £50 up to £100 because they've invented a new technology. The new technology hasn't been used yet, so their earnings have stayed the same, which means that their price-earnings ratio has doubled from 10 up to 20. Now this is okay if the company can double their profits in years to come, as this will bring the price-earnings ratio back down to the historic average of 10. However, if the CEO is correct and the new technology isn't as good as people think, and the company only increases their profits by, say, 5 or 10%, then the share price of £100 is too high compared to the fundamental value of the company. We can say it's overvalued, and the price-earnings ratio increase from 10 to 20 has given us an indication that this might be the case. You know, we can't say for certain, because if the company can double their profits, then it's fine. It's an appropriate valuation because of the promise of future returns. However, if they can't deliver their promise, then we can say that the stock's overvalued. So the increase from 10 to 20 we can use as an indication. However, it doesn't say anything for definite. Right, hopefully you're still with me. Let's actually apply this to the S&P 500 now. So what we can do is we can take what we've learned for an individual stock and apply it to the stock market as a whole. As in, if we look at the share price of the 500 companies within the S&P 500 and compare that to the earnings of the 500 companies within the index, we can then construct the price-earnings ratio of the S&P 500 as a whole. And if we look at this on a graph, then we can see that it's increased dramatically over time, especially in recent years. Now, this price-earnings ratio you're looking at is a modified version, something called the Shiller PE ratio, which takes into account factors such as inflation and other things to basically make it reflect reality a bit better. But what we can see is it's now sat at around 37.6. Now, this is way, way higher than the 10 to 20 times historic average that we've seen for many, many years previously. Now, this could mean a few things. It could mean that the top American companies are on the verge of a massive payday. For example, the likes of Apple, Nvidia, Tesla, Microsoft, Google, Facebook, etc. are about to make tons more money in the short term. And this would therefore bring the price-earnings ratio back down to more historic levels. And if this is true, then we can say that the S&P is actually not overvalued because it's an accurate representation of what's about to happen. And this could be true. For example, we could be on the verge of a massive AI revolution, and the top tech companies in America could be on the verge of a massive and sustained payday. Or, however, it could mean that investors have got overexcited in recent years and they've pumped money into the S&P 500, but in reality, the earnings aren't going to explode as people are predicting. Or it could be a combination of the two. For example, the big companies might be on the verge of big profit increases, but not to the extent that their share prices actually represent. So they're still overvalued, but to a lesser extent. And it's worth considering that there might be another force that's involved with pushing up the price of the S&P 500 and causing it to be overvalued, and that is the rise of retail investors, or everyday people becoming more and more involved in passive investing, i.e. just putting money into the S&P 500 without doing any fundamental research, and just buying a part of the market to let it carry you along the way. And this has proven to be a very, very successful strategy over the last few years. For example, like I said, when I put some money into the S&P as a teenager, that's exactly what I was doing. I was putting in money into the market at whatever price I was being quoted and just letting it take me wherever it went. So what this might mean is that there are a lot of investors that aren't doing any fundamental research on the companies that make up the S&P 500 index. They're just putting money in at whatever price they're being quoted. And I'm not saying this is a bad thing, I'm just saying that it might be skewing the market upwards and causing it to be more overvalued than it already is. Okay, so what does all this mean? Perhaps you're now on board that the S&P 500 is probably overvalued, but what does this mean for your investments? Should you sell now while the market's high, and should you hold off investing more until the market's corrected itself? Well, this really is a million-dollar question, and people always say that trying to time the market is often a fool's game, as predicting what the S&P 500 will do in the short term is very, very difficult. But what I will say is lots of professional investors, probably Warren Buffett being the most notable, is doing something very interesting. He's actually stockpiling cash in order to take advantage of higher interest rates and also being able to pick up bargains as and when they come available. As we know, interest rates since the pandemic have gone up massively to fight inflation. And what that means is if you're lucky enough to have some cash lying around, you're able to get some pretty decent returns for absolutely zero risk. And also, if there was to be a market correction in the near future, you'd have the cash on hand to be able to buy it as at a bargain when it's at its lowest. And this is essentially what value investors like Warren Buffett look to do. And this is obviously very different to passive investing and requires a lot more thought and research to go into it. But it's interesting to see what these professional guys are doing, and maybe you can adapt your own investment strategy to suit. Well, thanks for sticking with me through that. Hopefully you've learned something along the way. And I really thought that for myself, learning actually what it is for a stock market to be overvalued has really cleared up my thinking. And now I feel like I know what to do a bit better, or at least I know where the risks are and what might happen in the future. And if you've made it this far into the video, you're probably a lot like me and want to learn more about investing and personal finance. So please consider subscribing to the channel and let me know in the comments what sort of content you'd like to see next. Thanks for watching.